And Bitcoin right now, if you look at the whole investment universe, and you've seen this chart from Jesse Myers and Croesus, and he and I ran these numbers, and we came pretty close to almost the exact same investable universe. Michael Saylor's been using this in his presentations, the $900 trillion of investable assets. Well, Bitcoin's only $2 trillion of that right now ish. And so if you look at that as Bitcoin is, like you said, becoming a separate investable asset class, and just like gold. So people think of gold, they don't think of gold as, gold would be part of my stock or overall risk portfolio allocation. Gold is a separate asset. It's just like that, the digital store of value, ultimate digital store of value. And people are waking up to that.
Even Powell has said it.
That's right. So, and we've got some people in our administration now who are pro crypto and are actually Bitcoiners, and they understand that it's a store of value. And so, just looking at that, and as Bitcoin grows and gathers more assets, and that market value of Bitcoin grows, that volatility will dampen, and the institutions will get more and more comfortable coming into the space. When you look at the ETFs and the holdings of ETFs, sometimes you have massive players in there that people would not even recognize. And so one of those players is HBK, and this is a Dallas investment firm. It's a Dallas huge hedge fund that's got over $20 billion of assets, and they're one of the largest holders of the ETFs. Hundreds of millions of dollars of these.
What percentage of their
portfolio? Well, I don't know what the percentage of their portfolio is, because it's not public what their total assets are, and I haven't talked to them in a long time. But this is just one example of somebody that nobody would have heard of, but these are very smart people. Like Jamil is one of the smartest investors I know in the entire world, and he is allocating to it. That's a really big deal. Now, I don't want to, don't mean to call him out particularly, but that's just an example of one person that I know is extremely intelligent and is now in this space. And so that's important. So the point is, though, is that now we're starting to see players come into the space that may not have come in before because of those operational issues. Now, even hedge funds, but forget about pension funds and endowments. They couldn't come in before the ETFs. Now they can. Mm-hmm. So, but as Bitcoin does solidify itself as an asset in that total investable universe, and that volatility does dampen a little bit. I believe it's going to continue to be volatile for weeks and weeks, or months and months, and maybe some years here, likely years here. But once it does that, then it starts to draw from the rest of that investable universe, not just from stocks and risk assets, but now it's going to draw from bonds and from real estate, because it's an easier asset to get a hold of for real estate. Then you don't have to have management and oversight and maintenance fees and all those costs involved. Super simple. It's just a store of value, rather than have an illiquid store of value of real estate. You have a very liquid store of value in Bitcoin. I believe that will be one of the buckets it starts to draw from. And then obviously bonds, with everything we're seeing that's going on the sovereign level, and how all of that debt and all that risk in the great financial crisis was kicked up to the sovereign level. Mm-hmm. Now we have a problem there, and we have necessary debasement of our currencies, of our fiat currencies that you talk about all the time, that bond investors are waking up to. And they're realizing they need a better return on their longer dated bonds in order to get a real return against actual inflation, not the CPI inflation, but real inflation.
Right.
And so that's a kind of a big picture overview of where we're at and where Bitcoin kind of fits in, but it will eventually start to draw from those other asset classes, I believe.
Well, now that we have the ETFs and other vehicles like options where the market can express their views one way or another on Bitcoin, does that create an opportunity for any price suppression?
I don't know. Do I expect it? No. Do I believe that there's manipulation going on? No, I don't believe that. I just think that truly, I think, look, $100,000 has been a massive mental level for people. It jumped over it, came back, jumped over it, came back, jumped over. It's done it like 4 or 5 times. And I believe that there are some the OGs People have been holding on to this thing for a very, very, very long time, and they've made life-changing wealth, and they're going to enjoy it now, and they're cashing in a little bit. And that's okay. They have way more than you and I do, and they're just cashing in, and that's okay. But I don't believe it's being suppressed. That's not my belief. Is it possible? Sure, of course it is. But I do believe that institutions are now in here and taking advantage of this volatility. And once it does get over 100,000, stays over 100,000, and that mental level is gone, that becomes a support level. But we're not there yet, at least not today. So
when you're evaluating a portfolio's performance, can you break down simply what a Sharpe ratio is?
Yeah. Basically, in basic terms, the Sharpe ratio is just it's a measurement of the return of the return of your portfolio, and it includes the volatility in that return. So if you have a massive return, but you have massive volatility, it may hurt your Sharpe ratio, right? So, but if you have great returns and you just have slightly higher volatility, then your Sharpe ratio goes up. And
so you want a higher Sharpe ratio.
You want your Sharpe ratio over 1.0. That's what you really want. And so when you look at portfolios, you look at institutional portfolios, professional portfolios, you're looking at that Sharpe ratio to see how is this performing on a risk-adjusted basis. And so what I mean by that is that it's very volatile. Then it's riskier, right? As a portfolio. But if you have volatility, but it's that volatility is adding massive returns, then that's okay, which is a kind of a tee up to your initial question about the 60-40 portfolio. And so you can look at this. You can go on to Nakamoto portfolio.com, and you can create portfolios and look at what the impact is to your portfolio if you added Bitcoin to it. And so what institutions are starting to wake up to slowly, but they're starting to, and we're explaining it to them, we're teaching them this, is that if you look back over the period of the last 10 years, and you just look at the classic 60-40 portfolio, and you added any allocation to Bitcoin to it, it enhanced your returns dramatically. It only raised your volatility a little bit. And so it raised your Sharpe ratio. It made your portfolio a better risk-adjusted return than without Bitcoin. And that blows investors' minds. They can't believe it. They think that's just not possible. But it's because that it is volatile, but it's a volatility in a rising asset over time. And so if you hold on to that for a few years, it will enhance your portfolio undoubtedly, at least if you look back over the last decade. So if you pull up, like we can pull up the a 60-40 portfolio, and you can see how those Sharpe ratios they're affected. So I analyzed this for one of my newsletters, and if you look back the last 10 years through December through 2024, and you had a 60-40 portfolio, your return over those 10 years would have been 8.5% annualized. Okay, over that period. If you added just 1% of Bitcoin, just one, then your return would have gone up to 9.7% annually. So that's another 1.2% annually. So your entire return goes from 132% over those 10 years to 159%. Okay, but here's the crazy thing: your volatility is very similar. It's still 0.57% annual daily. And annualized, it went from 10.86% annualized volatility to 10.9%. That's it, just 4 basis points higher, which took your Sharpe ratio from 0.63 to 0.73. Okay, so we know that the bonds were volatile, so your Sharpe ratio was not that great over the course of that period of 2021 to 2023. So we know that, and it was. But if you added Bitcoin, it enhanced it. If you added 5% of Bitcoin to your portfolio, your total return went from 132% to 290%, and your annualized return went from 8.5% to 14.2%. Like, wow. Insane,
what
right?
A sweetener.
What a sweetener. Your volatility only went up to 11.7%. So it's less than 1% volatility rise, which took your Sharpe ratio up to 1.06. So
now you're above,
now you're a better Sharpe ratio. So now you're over that 1.0 kind of threshold for your Sharpe ratio. And then if you added 10% of Bitcoin to your portfolio, your total return would have gone from 132% to 520%. And your annualized return went to 19.5%. Your volatility only went up to 13.75% from 10.86. Yeah, it's more volatile, definitely. It's 3% more volatility annually. But your Sharpe ratio went to 1.29. Yeah. So it still went up.
Give me your 30-second to 60-second pitch of why Bitcoin over, let's start with real estate.
Well, I mean, they're different assets, right? So if I was going to measure them up against each other and arguing for Bitcoin, well, real estate, it's problematic for a number of reasons. It's illiquid. It has a lot of maintenance and fees associated with it often, and taxes associated with it often. If you're doing like multifamily units, you've got to get tenants in there. You've got to deal with that oversight. You've got to deal with a management company or pay a management company or deal with that yourself. You do get cash flows. It has been a good store of value, especially in areas where it's where there are only a certain number of units, like oceanfront property, for instance. There's only so many that are ever going to be there. And so that's good. But if you're trying to use it as a store of value, Bitcoin's so much easier because you just buy it and hold it. That's it. You don't have to deal with any of the stuff. Yeah, you don't get cash flows from it, but you don't have to deal with any of the headache of it. You just buy it, hold it, put it away. And so that's a very simple one.
What's the argument for Bitcoin over the S&P 500?
Well, I mean, S&P 500, if you buy the whole S&P 500, well, you're just buying 500 companies, and you're riding out that risk. You're locked into the risk on market, and so the economy has to be expanding. It has to be expanding in real terms in order to make a real return on that, not just with inflation. And so if you're going to be investing in companies in the S&P 500, well, then you've got operational risk, you've got execution risk, you've got all kinds of single name risks that could be that could bite you when you're an investor. And even if you have 10 names, if you have one name blow up, then that's a single name, risk. And you have to understand that. So my argument for Bitcoin on that is that over the long period of time, I believe that Bitcoin is going to separate. It's going to become uncorrelated to the S&P. It's not going to have that correlation to, especially with the tech sector that we've seen, where it's the tip of the risk spear. I think it's going to decouple from that. Once we get to a certain size, I believe it decouples, and then it doesn't follow it like that anymore.
And this should be the easiest one. What's the argument for Bitcoin over bonds?
Yeah, well, bonds don't give you a real rate of return over the long time. That we've discussed it half the show. And Bitcoin is just the ultimate store of value. If you want to store your money in something and know that it's there, and if the money supply expands, there will be more dollars chasing it. And that means that, or whatever currency you're in, and the dollar is the best one, that that over the long period of time that it'll appreciate, meaning that whatever currency that you're valuing it in will debase against it, will depreciate against it, and you'll get more of those to use in exchange for whatever you want to do in life.